We have had a lot of people from the bullish camp on our show this week, so we went looking for a bear just to balance things out, and we found one. Douglas Ramsey is Chief Investment Officer at the Leuthold Group. He says, be prepared for a 25 to 30% drop in U.S. stocks. Doug joins us from Minneapolis this morning. The Leuthold Group manages about $3.5 billion. Doug, let's start off with this. I want to play you an excerpt from an interview we did just a couple of days ago with Brian Belsky, the Chief Investment Strategist at Oppenheimer, definitely in the bullish camp. He says the market hit bottom this week. Listen to what he had to say.
There's too much reaction, too much emotion in the marketplace. You talked about a bottom. When you see these types of fears all swelling and everyone on the same trade, correlations are very, very high. That usually spells that we're at a bottom, and that's what happened yesterday.
So tell me, Doug, did we hit a bottom this week? I know you don't think we did, but Brian says too much emotion in the market. We're putting in a bottom. Why is he wrong?
Well, you know, I think it's probably a decent short-term bottom. You know, we're entitled, you know, after the down leg that we had, we're always entitled to, you know, an 8 to 12% bear market rally. I think that's in place right now. But consider that if the Monday closing low on the S&P was the bear market low, here's a way to look at it, is that it would be the third most expensive bear market low from a valuation perspective in history. The only two that were more expensive was in the fall of '98 as the technology and the overall stock market bubble were escalating. And then again in October of '02, which is when that bubble had finally broken and had been only partly deflated.
Doug, when you say
this would be the third most expensive one, and just considering the environment, it seems that, you know, we'll go down and make a much more typical bear market low from a valuation perspective.
Now, when you say valuation, you're talking about price to earnings?
A variety of things. We track about 40 to 45 different intrinsic value indicators in our major trend index. That's what guides our overall asset allocation. You know, we don't focus or place very little emphasis on forward earnings.
Well, you know,
because strategists.
I want to interrupt for just a moment because and try to focus our conversation on this point about forward earnings. Scarlett was mentioning a few minutes ago that the expectation for next year is at about $101 of earnings per share for the S&P 500. Belsky, whom I just introduced a moment ago, had something to say about earnings as well. So let's hear what he had to say, and then we can go back to this conversation about forward earnings.
Earnings drive stock prices, and we believe Wall Street analysts and buy-side analysts have undercut earnings for the third quarter into next year too much. Corporate America has gone through so much structural reform in the last 10 or 12 years that they continue to be positioned to underpromise, over-deliver. We think earnings will surprise to the upside.
So clearly, Doug, many of the strategists do base their expectations on an earnings forecast for next year. Why don't you give as much weight to this forward look into earnings?
Well, you've really got to bet, you know, to get that $105, $110 in earnings, or 101, I guess, maybe is the consensus forecast. You've really got to bet on a serious reacceleration in the economy, which we don't see happening in the short term. You've also got to assume that margins are going to remain at historically peak levels. I mean, there's always this period, the first couple months or first couple years into an economic recovery, where productivity gains allow this dramatic margin expansion. We've now had that. And the next phase, even if we skirt recession, and that's still our best guess that we don't have a recession here in the U.S., that margins still come under pressure.
Now, the European factor is something I know you've been considering. We've been talking about here for months and months and months. Michael Shaul of Market Field Asset Management spoke to my colleague Betty Liu about Europe and the ECB yesterday. Here's a short excerpt from that conversation.
I'm sure some people hoped that he would have cut rates today, but the fact he didn't really worry people. You know, the ECB has been doing one thing, though. They're not talking about it, but they're doing it. They are expanding their balance sheet. Their balance sheet has grown by roughly 18% over the last 13 weeks. You know, that's a little bit more than $300 billion.
So it almost goes without saying that anybody who is exceptionally bullish has to feel as though things are going to work themselves out in Europe in such a way that we don't end up in some kind of a global recession. What's your view?
Right. I still think there are going to be a couple more waves of panic to come out of Europe yet. I mean, just because government decree is trying to address this, it does not solve the problem. I mean, we learned that with TARP and all the efforts in late '08. I mean, the bear market went on to fully express itself, and we still think that will happen here. So, you know, our sort of baseline downside target on the S&P is 975. That'd be, you know, 27, 28% decline on the S&P. It would get us down to long-term bottom quartile valuation. So if we get down to there, you know, we're very defensive now in terms of equity exposure. In our managed accounts, we're only about at 33%. You know, if we see 980, 975, we'll take it up to 50%, really regardless of how bad the news might be out of Europe at that point, just because valuations, I think, at that point give you somewhat of an entry point into the U.S.
Doug, before we go, just quickly, how long do you think it'll take before we see those kinds of levels, 975?
I think in the next 4 to 8 weeks. You know, this entire bear has unfolded pretty quickly. As I said, you know, we've done a lot of work dividing bear markets into recession-related ones and non-economic or recession-free bear markets. We still think this is going to be the latter, and those tend to unfold in a much quicker time period. 6 or 7 months is typical. We'll be about there by the end of this month or early next month.
Doug, thanks for your bearish view, I guess, but it is important to balance one against the other. Good to see you this morning. Doug Ramsey, the Chief Investment Officer of the Leuthold Group.